Welcome to CoreLogic's update on Australian housing market conditions for July 2016. The pace of capital gains showed some moderation over the month of June, slowing to 0.5% after CoreLogic's home value index surged by a total of 3.3% over the previous 2 months. Although the headline results showed a reasonably strong rate of growth in dwelling values, 5 of Australia's 8 capital cities recorded a decline in June. Monthly declines of more than 1% were recorded in Darwin, Adelaide and Canberra, while the falls in Brisbane and Perth were less severe. The June growth figures can be attributed once again to strong gains in Sydney and Melbourne, where dwelling values rose by 1.2% and 0.8%. Hobart also showed a substantial rise of 1.8% over the month. While the higher rates of capital gains in Sydney and Melbourne can be tied back to strong economic conditions and high rates of population growth, the same can't be said for Hobart, where economic conditions and migration rates are gradually improving from a low base. The rise in capital city dwelling values in June has pushed the year-to-date growth rate up to 5.5%, which is slightly higher than the 5.1% increase recorded over the first half of 2015. With the recent surge in monthly growth, the annual pace of capital gains has rebounded from a recent low of 6.4% earlier this year to reach 8.3%. However, the annual trend remains well below the peak of 11.1% seen in July last year. Sydney and Melbourne are seeing dwelling values rising at just over 11% per annum based on the June data, with Hobart the only other capital city to record an annual gain of more than 5%. Values were down by 4.7% and 1.1% in Perth and Darwin respectively. The growth cycle has now been running consistently for 4 years, taking capital city dwelling values 37.3% higher over the cycle to date. Sydney has well and truly outpaced all other capital cities, with appreciation in dwelling values recorded at 59.3% over the cycle to date. Melbourne dwelling values are 40.5% higher, with the next best performing capital city being Brisbane, with a lower growth rate of 18.3%. The June reduction in the monthly rate of growth is likely to be very much welcomed by federal and state government policymakers and regulators, who may have been becoming concerned about a sustained rebound in capital gains. In our view, the rate of capital gains is likely to decelerate further over the remainder of the year due to a range of factors, including affordability constraints, low rental yields, and a growing acceptance that the growth cycle is likely to be at or close to its peak. Recent dwelling price to income measures released by CoreLogic using household income data from the Australian National University show that Sydney's dwelling price to income ratio has reached 8.2, indicating that dwelling prices are 8.2 times higher than annual household incomes. Melbourne shows a healthier affordability index compared with Sydney. However, dwelling prices remain 6.8 times higher than household incomes. As the year progresses, further interest rate cuts are likely, which could bring mortgage rates down even further. Whether lower mortgage rates will stimulate the housing market is yet to be seen. However, a rebound in home value appreciation is likely to be on the regulatory radar. If the pace of capital gains remains consistently high, there's the potential for a further regulatory response aimed at keeping the lid on the pace of capital gains in the housing market, whilst also allowing for low interest rates to stimulate the broader economy. As always, thanks for tuning to the CoreLogic overview of housing market conditions. There's plenty more research and housing market insights at our website, located at www.corelogic.com.au.